Are some of the investors that you admire the most?
Well, you know, the obvious, you know, you can learn a lot from Warren Buffett. You should read his annual report. I would say that I'm very much influenced by Marty Whitman at Third Avenue. You should read his letters because what he really stresses is the balance sheet, and that's where I get more of my margin of safety is the balance sheet. Again, and that's where I incorporated a lot of my ideas. I basically stole what he said and incorporated that. My best friend in the business, David Sammer, runs the Artisan International Fund. He's an excellent money manager. So those are the you know, the guys who run the Clipper Fund, I think, are pretty good. Davis, I think, is his name. Let's see who else. Fairholme, I think those guys are pretty good. Those are all no-load mutual funds. Guys at Harris, I think, do a good job. So the one issue you got to deal with no-load mutual funds, though, is that even though they're no-load, once they get up their assets above $10 billion, they are the market. They're not going to outperform that much for a long period of time. So I guess that. And the problem is successful money managers tend to get a lot of money, and eventually they do become the market. So.
Did you know Bruce Berkowitz went into Citibank and AIG? Big time?
Yeah. Well, I mean, I read the newspaper. I didn't read it in that much detail, but I heard the headline or something like that. So, you know, he's probably doing it at the right time in the cycle. I mean, my guess is that we've seen the worst of the crisis. So, I mean, that's just a guess, but it just seems that the confidence is coming back to the system, and that's the most important thing.
You talked about target price. How
Yeah.
do you calculate the target price?
Well, it goes back to what I was telling Ray. If you think a company's going to earn, Seaco's going to earn $3.50 in 2011, what's that worth to you? It's worth more than $35, I would say, right? Is it worth more than 100? No, I don't think it's worth more than 100. But, you know, is it worth $50? Well, if it's growing, you know, the company has a very strong balance sheet. They've been buying back a lot of shares. For-profit education obviously has its controversies, but the bottom line is that if you're going to retrain America, working adults in America, you're going to need companies like career education. I think that management team does a much better job than most for-profit education companies in that they're actually very concerned about the outcome of the students. So you have to add all that back in there, and then you have to ask yourself, well, with all the risks, because for-profit is very controversial. The administration has been picking at them in terms of coming up with regulations called gainful employment and things like that. You know, with all that risk, you know, would I rather own this or the 10-year Treasury yield? And, you know, 10-year Treasury yield, you know the payment's going to be there, but you don't have any inflation protection. And, you know, Seaco can continue to grow from 80, I think they have 100,000 students, but they go to 200,000 students. You know, they can continue to grow like that. I would say that that tuition is generally inflation protected, right? If inflation goes up 2% a year, I'm pretty sure St. John's is going to raise their tuition 2% a year, at least. And what's ironic is when you have the more the government subsidizes student loans by direct lending and Pell Grants, even though the heart is in the right place in terms of trying to help families afford ever-increasing tuition costs, that in fact just raises tuition costs. It just gives universities, you know, that more room to say, well, you know, the typical family of four can now increase, you know, afford this tuition rate because the government just gave them a Pell Grant. It'll just pass through, and the tuition will just keep on going up. Unfortunately, because of what's going on. So you have all that backdrop, and you say, well, $3.50, company buys back shares, so it goes to $4 the next year, $4.60 the year after that, or something around that derivation. How much are you willing to pay for that? Well, it's trading at 33 now. It has $5 in cash. It really is trading at 28. So for 28, you're paying, I don't know, what are you willing to pay for it? More than 28? 70? I don't know, maybe I'll sell some shares at 70. But that's the type of game you play. That's the target price. And I have a target price for each year. I have a target price for this year and next year. So I know what the value of my portfolio is. If you read, there's a mutual fund asset manager out there called Southeastern Asset Management. Very good stock pickers. They write a very good letter. And if you read their letter, they talk about price to value. That's all we are doing. We're just trying to figure out the price to value. And you can tell when your fund is expensive and when it's cheap because you measure I measure price to value in my fund. And if you look, the times when my price to value go way up, usually I had a corresponding market drop or a market drawdown then. And usually it's a coil spring. In other words, the next 12 months that my market performance will be much better over a period of time. And again, it's not an exact science, and you're gonna, I'm wrong 80% of the time. Not, there's going to be times I'm wrong, but usually, usually you can tell when your portfolio is expensive or cheap.
What's the turnover in your portfolio?
Pretty low, about 20%. I'd say 90% of the gains are long term.